Hi everyone, welcome back to Let's Talk Audit and Assurance. You're still with me, Christine, your auditing theory conversation partner, and I am especially excited about this module because if you have noticed, we are done talking about the entire audit process, and this module actually brings us back full circle to one of our earlier discussions here in my YouTube channel, Let's Talk Audit and Assurance, when we talked about assurance engagements and how a practitioner can actually perform so much more than just an audit and even so much more than just assurance engagements. We said as a practitioner, you can perform both assurance and non assurance engagements. And finally, we have come to the point where we're going to talk about what these other services are. So let's start with the review engagements. Now, I know we have talked about review engagements also previously, but let's just revisit it. Our main standard for review engagements would PSRE 2400. Now, we know that review procedures are limited. This is the reason why it is not in the same level of audit when it comes to the assurance being provided. So, review procedures are primarily limited towards inquiry or to inquiry and analytical procedures. And with that, the assurance obtained is only limited and the conclusion expressed is only negative. So previously we said the reason for this negative conclusion is anchored on the fact that while an auditor has access to any and all procedures necessary to reach the audit objective, in the case of review procedures, the practitioner is limited only to performing inquiry and analytical procedures. Now, even so, it is still possible for the reviewer or the practitioner to be able to encounter information that may cause or that may lead the practitioner to see or to believe that there may be a material misstatement. So in this case, if there are matters that may cause the information to be materially misstated, then the practitioner must endeavor to perform additional procedures in order to determine if such material misstatement does exist. So, if upon performing these additional procedures it was found out that no material misstatement exists, then the practitioner can proceed to giving an unmodified conclusion. However, if there is a material misstatement and no revisions are made, the practitioner can modify the conclusion. And the modifications may come in the form of qualified, adverse, or disclaimer. So it does sound a little bit like the modified opinions that we give when we perform an audit. However, there is a difference in the way that the review report is being presented. So let's take a look at how these review reports would look like. So in case of an unqualified opinion, the review report would sound something like this. So we have reviewed the accompanying financial statements. So it will start with an identification of what financial statements were reviewed. Very important for us to mention that these financial statements are the responsibility of management, and in the case of the practitioner, the responsibility is to issue a report based on the review. Okay? And then on the second paragraph, we conducted our review in accordance with. So again, very important that we inform the readers that, hey, readers, this is a review. And a review is limited primarily to inquiries and analytical procedures. If we take a look at the last line of the second paragraph, we have not performed an audit, and accordingly, we do not express an audit opinion. We have to explicitly state that in order to avoid misunderstandings from the readers of our report. Based on our review, nothing has come to our attention that causes us to believe that the accompanying financial statements are not presented fairly in all material respects in accordance with PFRS. So notice in the last paragraph, which contains the conclusion, this, my friends, is where we get to see the negative conclusion in action. So nothing has come to our attention. This is how an unqualified review report would look like. However, we did mention it's possible for the practitioner to give a qualified or a modified conclusion. And so in the case of a qualified conclusion for review engagements, it will sound something like this. So the first paragraph will be the same. We have reviewed and our responsibility is to report based on our review. The second paragraph is the same. We conducted our review in accordance with PSRE 2400. This is not an audit. We do not give an audit opinion. And then take a look at the third paragraph, which now contains the reason for the qualification. According to the third paragraph, management has informed us. This is a very important phrase. Management has informed us. Mainly because our procedures are limited to inquiry and analytics. So we found out about this because management has informed us that inventory has been stated at its cost, which is in excess of its net realizable value. Management's computation, which we have reviewed, shows that inventory, if valued at the LCNRV as required by the accounting standards, would have been decreased by such an amount, and net income and shareholders' equity would have been decreased by such an amount. So we basically outline here what is the basis for us giving a modified conclusion. And in the last paragraph, which includes the practitioner's conclusion, it states, based on our review, except for the effects of the overstatement of inventory described in the previous paragraph, nothing has come to our attention that causes us to believe that the accompanying financial statements are not presented fairly in accordance with PFRS. So the use of the except for terminology is the same, right? We use except for as well when we give our audit opinion. So similar to a review engagement, we also make use of except for. We do get to notice, very importantly, the phrase based on our review. And again, here we get to see the negative conclusion in action. Now, if on the other hand, the practitioner or the reviewer gives an adverse opinion, so the first two paragraphs are essentially the same. The third paragraph will include the basis for why the conclusion is adverse. So, as noted in footnote 10, these financial statements do not reflect the consolidation of the financial statements of subsidiary companies, the investment in which is accounted for on a cost basis. So, the company failed or refuses to consolidate the subsidiary companies. Under PFRS, the financial statements of the subsidiaries are required to be consolidated. So, in the conclusion part, based on our review, because of the pervasive effect of the financial statements of the matter discussed in the preceding paragraph, the accompanying financial statements are not presented fairly in all material respects in accordance with PFRS. Notice that when the reviewer gives an adverse opinion, it kind of sounds almost like our adverse opinion in an audit, right? However, we still highlight the fact that it is based on our review. So these are the different modifications that you may find in case of review engagements. So let's now move forward to agreed upon procedures. And for agreed upon procedures, we refer to PSRS 4400. Now we recall in the Philippines, agreed upon procedures engagements are not assurance engagements. Remember, they are part of the related services because they have not met all of the five elements of an assurance engagement. They are not assurance engagements. I have to tell you that as early as now because if you are reading foreign authored books, some countries, their agreed upon procedures engagements is an assurance engagement. So they require their practitioner to give a conclusion on the AUP or agreed upon procedures. But in the Philippines, our AUP is not an assurance engagement. Because it is not an assurance engagement, then independence is not required. We recall that independence is required for all assurance engagements. So in the Philippines, because AUP is non-assurance, independence is not required. However, please do take note that in case where the practitioner is not independent, the practitioner must disclose this one in the report of factual findings. So independence is not required, but should the practitioner not be independent, the practitioner must disclose it, all right? Must disclose it in the report of factual findings. So in agreed upon procedures, we also recall that the procedures to be performed are audit in nature and that these procedures have been previously agreed upon with the parties in the said engagement. Okay, the entity, the practitioner, and any appropriate third parties have agreed to these procedures. Because it's non-assurance, assurance obtained is none, conclusion expressed is none as well. The report that is going to be issued is called a report of factual findings, and this is how it's going to look like. So this is the report of factual findings. Address it to whoever engaged the practitioner. We have performed the procedures agreed with you and enumerated below with respect to the accounts payable of ABC Company as at a specific date set forth in the accompanying schedules. Our engagement was undertaken in accordance with PSRS applicable to agreed upon procedures. These procedures were performed solely to assist you in evaluating the validity of the, in this illustration, accounts payable, and are summarized as follows. So notice what the practitioner is doing. The practitioner is enumerating what were the procedures that were performed. This is to alert the readers of the report that these are the only things that we performed. This is not a full blown audit. These are the procedures. These are the only procedures we performed. Afterwards, the practitioner will then proceed to enumerating as well what were the findings. That's why it's called report of factual findings. So, for example, we report our findings below. In the case of letter A, with respect to item 1, we found the addition to be correct and the total amount to be in agreement. Letter B, with respect to item 2, we found the amounts compared to be in agreement. So you basically enumerate as well what were your findings. Let's take a look at letter D. With respect to item 4, we found the amounts agreed, or with respect to amounts which did not agree, we found ABC Company had prepared reconciliations and that the credit notes, invoices, and outstanding checks over a certain amount were appropriately listed as reconciling items with the following exceptions. And then the practitioner lists down what are the exceptions. So the idea of a report of factual findings is that we leave it to the readers of the report to make their own conclusion. We just tell them what we saw. Okay? And then, because the above procedures do not constitute either an audit or a review, we do not express any assurance. It's very important for us to explicitly mention this one. Again, to alert the readers that this is not an assurance engagement. Okay? Had we performed additional procedures or had we performed an audit or a review, other matters might have come to our attention that would have been reported to you. But we did not. We simply performed agreed upon. Our report, therefore, is solely for the purpose set forth in the first paragraph and will not be used for any other purpose or distributed to any other parties. So, in a way, here, the practitioner is restricting the distribution of the report. Alright, so this is how a report of factual findings would look like in relation to agreed upon procedures. We now move forward to compilation engagements, and this is covered by PSRS 4410, Philippine Standards on Related Services 4410. We recall that a compilation uses only accounting expertise. Okay, it ordinarily includes the preparation of the financial statements and may also include the collection, classification, and summarization of other financial information. At this point, let's again highlight a possible difference between the provisions of our Philippine standards and those of other countries. In the US, for example, they make a separate reference to the preparation engagement and the compilation engagement. So, to them, preparation and compilation are two distinct engagements, whereby the compilation engagement includes the reporting, a compilation report. But in the Philippines, no such distinction is made. Okay, so because of that, when we view compilation, we see it as ordinarily including the preparation already of the financial statements. Notice again that what is being used is accounting expertise. Okay, accounting expertise. This is a non-assurance engagement, and because of that, no conclusion is also expressed. Now, the report that is going to be issued, the compilation report, should contain a reference such as, for example, unaudited or compiled without audit or review, or refer to compilation report to again alert the readers to the fact that these financial statements have only been compiled, they have not been examined, they have not been audited. Okay? Now, regardless of the fact that you did not audit or did not examine it, it is still, I think, a basic requirement, right? So it's kind of like common sense that the practitioner should still obtain a general understanding of the nature of the entity's transactions because, well, you will be assisting in the preparation of the FS. So you should have an idea of the nature of the business transactions, the form of the accounting records, and the accounting basis on which the information is to be presented. The bigger question now is how will the practitioner obtain such general understanding when all the practitioner uses is accounting expertise? The answer is it will be obtained through experience with the entity or inquiry of the entity's personnel. So here you will notice an even more limited scope, right? Whereas in audit, you will have, free access to any and all procedures you deem necessary. In review, you will have access to inquiry and analytical procedures. Here, in compilation, it will only be through your experience and inquiry of the entity's personnel. Let's take a look at an example of a compilation report. So notice that the compilation report is being addressed to the management of the company, so to the management of ABC Company. We have compiled the accompanying financial statements of ABC Company based on information you have provided. These financial statements comprise the statement of financial position of ABC Company as at December 31 and the statement of comprehensive income, etc., etc. So identifying the financial statements covered. We performed the compilation engagement in accordance with PSRS 4410. That is about compilation engagements. We have applied our expertise in accounting and financial reporting. Okay, so we're highlighting the fact that what we are performing is accounting and financial reporting to assist you in the preparation and presentation of these financial statements in accordance with the criteria set. We have, in this case, PFRs for SMEs, we have complied with the relevant ethical requirements as well, because even if it's non-assurance, we are still required to comply with the fundamental ethical requirements. These financial statements and the accuracy and completeness of the information used to compile them are your responsibility. This is a very important statement to be included in the compilation report because, again, we have to let management be reminded that yes, we are assisting you in the preparation and presentation, but at the end of the day, management, these are still your responsibility. So since a compilation engagement is not an assurance engagement, we are not required to verify the accuracy or completeness of the information you provided to us to compile these financial statements. Accordingly, we do not express an audit opinion or a review conclusion. So this is how a compilation report would look like. So we have covered the three major other services. Let's take a look at this time report on compilation of pro forma financial information, taking notice that this engagement is a report on the compilation. Okay, so it's not the actual assembly, the actual compilation, but it's a report on the compilation of these pro forma financial information. So at the very start, let's answer the question, what is the purpose of a pro forma financial information? So pro forma financial information illustrates the impact of a significant event or transaction on unadjusted financial information. That means you start with historical actual information. Say, for example, you will start with maybe the financial statements as of and for the year ended December 31, 2017. Okay, for example, and you would like to illustrate the impact of a significant event or transaction had it happened in 2017. So, say, for example, you would like to illustrate what would have been the impact of the pandemic brought about by COVID 19 had it happened in 2017. So, you kind of like pulling back to the date of the unadjusted financial information a significant event or transaction. Okay, so it is usually included in a prospectus, and a prospectus is a document issued pursuant to a legal or regulatory requirement relating to the entity's securities on which it is intended that a third party should make an investment decision. If you've ever dabbled a little bit into investing, then you might have seen a prospectus. Now, generally, you will be asked to assess whether you are risk averse, whether you're conservative, whether you're aggressive, okay, in your investments, and you may have chanced upon a prospectus. Allow me to just move forward a little bit. This is not very clear, but I got this one from Investopedia. This is an example of a prospectus. So basically, what is the security offered? Who is the issuer? What's the principal amount? When is the maturity date? The issue price, the interest rate, the interest payment dates, and so on. So this is how a prospectus would look like. Okay, so a what they call this one, a pro forma rather prospective, a pro forma financial information is usually included in a prospectus. So the pro forma financial information will be arrived at this way. So of course you start with unadjusted financial information. So this is your historical FS. And then to that, you add or deduct your pro forma adjustments relating to the significant event that you would like to illustrate on that date. Okay, and then you will come up with your pro forma information. So, for this engagement, the objective of the practitioner is to obtain reasonable assurance. So, when you're thinking about the level of assurance, it's similar to the level of assurance provided by an audit, right? The auditor, the practitioner obtains reasonable assurance on the compilation of the financial information. But even when the level of assurance is reasonable, just like an audit, the fact still remains that this is not an audit. So, in instances whereby necessary amendments are not made, okay, so there need to be adjustments and said adjustments are not made, the practitioner shall, here are the options of the practitioner. Number one, withhold the report, or the practitioner may withdraw from the engagement, or the practitioner may consider seeking legal advice. Because again, you are reporting on the compilation of the pro forma information and not performing an audit. So therefore, if there are adjustments that need to be made and management says no, our options will be a little bit different, a whole lot different actually. So to withhold the report, withdraw from the engagement, or to consider seeking legal advice. So as what we have shown, this is an example of a prospectus. We now proceed to an examination of the prospective financial information. Emphasis and highlight on the use of the word examination. An examination is actually similar to an audit. The main difference is if you talk about an audit, it refers to historical information. But if you talk about examination, examination is the broader, more generic term. So if what is being audited is non-historical, like in this case, prospective, then examination is the technically correct term. Okay, so speaking of prospective financial information are financial information based on assumptions about events that may occur in the future and possible actions by an entity. Notice the difference between prospective financial information and pro forma. Pro forma is you start with the historical date and then a significant event that has transpired will be brought back to that date. What will be the effect had it happened on that date? But for prospective financial information, these are future events, assumptions about events that may occur in the future. Okay, now these future events or these prospective financial information may come in the form of a forecast or a projection. So when we talk about a forecast, these will be assumptions about events based on management's expected action. Okay, so meaning to say management has evaluated and management has planned. These are the expected actions. So for forecast, I'd normally use the mnemonic FE, FE, like for iron, or if you have a friend who is FE, that friend may help you remember that if it's forecast, F, then E, so expected action. Because you're talking about expected action, so a forecast may either be limited or general in use. In contrast, when you talk about projection, projection would be assumptions based on hypothetical, okay, or what if scenarios, meaning these have not been assessed or evaluated by management. This is not part of the plan of management, but basically just what if or hypothetical scenarios. And because of that, it is generally limited in use. The level of assurance provided is moderate or limited, and the conclusion given is negative. So just like a review. However, please note that the auditor is not precluded from giving a positive conclusion in the case or giving a reasonable assurance when the level of satisfaction is obtained. So there is no stopping the auditor, there's no stopping the practitioner from expressing a positive conclusion, provided that a reasonable level of assurance is obtained. However, as a general rule, this will be limited level of assurance and negative conclusion. And finally, we cap off this discussion by talking about letters for underwriters. So, who is an underwriter? So, an underwriter is any party that evaluates and assumes another party's risk for a fee in the form of either a commission, a premium, a spread, or an interest. So imagine, for example, that we have a listed company, and of course, this listed company would like to sell its shares to the public, right? But prior to selling to the public, this listed company may get an underwriter, okay, or that which we call an investment company. So the listed company sells the shares at a fixed price to the investment company. And then it will be the investment company who will eventually sell this one to the public. The idea is to sell it at a premium. So therefore, whenever the shares of the listed company benefits from an upward fluctuation or suffers from a downward fluctuation, then it will be the underwriter who will reap the benefits and also suffer the consequences, no, of the changes in the value of these shares. So that is why we're saying that the underwriter assumes another party's risk for either a fee or, in the case of commissions, premium spreads, or interest. Now, where does the comfort letter come in? So, di ba, notice we have a listed company. Di ba, we have a listed company. So, we have a listed company. The listed company, of course, has an auditor, right? And the auditor issues an audit report. Now, the auditor will also issue what is called a comfort letter. Now, a comfort letter is a letter that is written to the underwriters to give them comfort about the financial data contained in the prospectus that is not covered by the accountant's report. So notice previously we gave an example of a prospectus and there are information there, for example, regards interest, regards maturity, regards the outlook for that particular investment. So the underwriters, because they're the one who will assume the risk, would like to have some certain level of comfort or confidence on the financial data. Now notice as well that the audit report may cover a different period from the period that is covered or needed by the underwriter. So assuming that the audit report is December 31, but then the IPO and the transaction with the underwriter may be March 30 of the next year. So there's an intervening period, right? So this is the intervening period where the auditor will provide a comfort to the underwriters about. So in comfort letters, the CPAs will provide positive assurance that they are independent and that their audit followed SEC standards. So the positive conclusion, the reasonable level of assurance, refers to the audit report, okay, covering historical financial statements. And then, because remember the intervening period, and then they will provide negative assurance or a summary of findings on the various types of accounting matters related. So, in the intervening period between the audit report and the period covered by the comfort letter, that unaudited period, the auditor may either perform a review or an agreed upon procedure. So if it is a review, then the auditor will give negative assurance. If it is a UP, then the auditor will give summary of findings. Okay, so normally this negative and summary of findings will cover the unaudited, condensed, and summarized interim information. So I hope that when you see the word condensed or summarized, this will bring you back to our previous discussion on audit reports, right? And the summary financial statements. So, or pro forma financial information, which we have discussed just previously. Change subsequent to the balance sheet date. This is your subsequent events. And on various tables of data. So that intervening period is what will be generally covered by the comfort letter. So the positive assurance coming from the audit report and then negative or summary of findings for the intervening period. So that's about it. Those are the other services that we have decided to put a highlight on in this lecture video. I thank you so much for joining me and I hope to see you in the next video. Thank you and bye.